we're building more and more. The U.S. is going to be AI dominant. And so when you think about it, AI infrastructure is really going to be the foundation, and it's going to be the foundation for the future economy. And there is no AI without infrastructure.
All right, joining me will be Rob Thummel, Managing Director and Senior Portfolio Manager at Tortoise Capital, who currently offers 5 ETFs, about $1.5 billion in assets. That includes an ETF that just launched last week, the Tortoise AI Infrastructure ETF, ticker symbol TCAI, which that does exactly what it says. It offers exposure to the underlying infrastructure critical to the growth of artificial intelligence. They would refer to this as an energy adjacent investment strategy. And then they have 3, what I would say are much more directly focused energy ETFs, including a launch from back in June, the Tortoise Energy Fund, ticker TNGY, which has over $500 million in assets. So this was a mutual fund to ETF conversion. And then they offer a global water ETF as well. But Tortoise clearly focuses on the energy sector. That's their expertise. And so we're going to look at several of those ETFs, and I'm going to have Rob lay out why you may want to consider energy exposure in a portfolio to begin with. But I'll tell you, Rob is one of the sharpest minds you'll find in the energy space, over 30 years of experience in the industry. He oversees some $9 billion in publicly traded securities focused on energy and infrastructure. You'll also frequently find him appearing on places like CNBC, Bloomberg, Fox News. Again, he knows the space inside and out, and so it should be an excellent conversation. Now, to start this week, I have another one of the sharpest minds you're going to find in the energy space, Stacey Morris, head of energy research at VettaFi. This will definitely be the energy episode of ETF Prime, but there has been a lot going on here recently, so I think perfect timing. And Stacey and I are going to have a pretty wide-ranging conversation around this space right now, including that energy only represents 3% of the S&P 500. I'm very curious to hear what Stacey thinks about that. We'll also look at a handful of energy-related ETFs, which have been performing very differently. There's been some real performance dispersion here. And then I will get Stacey's high-level outlook on oil and natural gas prices as well. So a lot to cover. And let me now welcome in Stacey Morris, our resident energy expert. How have you been? Great having you on the podcast.
Yeah, doing well, Nate. Thanks for having me, and excited to be on this new format.
I love it. It's great to see everybody. And so let's start where we usually do, which is by looking at the energy space more broadly. And if you look so far this year, the Energy Select Sector Spider ETF, XLE, again, that's just a broad proxy for the energy space overall. That ETF is trailing the S&P 500 fairly substantially. And it has been up and down, right? It had a great first quarter, been a very rough second quarter, and then it's basically, I would say, treaded water so far in the third quarter. So just give us some of the main headlines here, like what's been going on with the energy sector this year overall.
Yeah, so I think we have to start with what's been going on with oil. So oil had, I think, a surprisingly strong first quarter. Oil got it, just over $80 per barrel in January, but generally was pretty strong. And you saw that reflected in strong performance in energy stocks, with energy being the best performing sector in Q. Now, after that, in April, you had the tariff tantrum hit. And at the same time that these tariffs were being rolled out, and you saw a broad market sell-off, you also saw OPEC Plus come out and announce they were going to add about 3 times as many barrels in May as they did in April. So that's kind of a double hit on oil price, because you have more supply coming on, and the read-through from tariffs was essentially the main concerns around oil. We've also had a lot going on geopolitically. I won't get into all of that, but we saw, in June, with things kind of heating up between Israel and Iran and U.S. involvement, that oil prices jumped up again, but then kind of quickly fizzled as that de-escalated. So there's just been a lot going on in the market from a geopolitical standpoint, tariff standpoint, in terms of OPEC plus unwinding. And that's, I think, just made it tough for the commodity and tough for the stocks to work. Energy stocks just really have not recovered from what happened in April. And so if you kind of fast forward to where we are now, OPEC plus is bringing another 550,000 barrels per day back on in September. So you're looking at, over 2 million barrels per day, about 2.5 million barrels per day, being added between April and September, at least in terms of kind of the headline number. And then you're also heading into a seasonally weaker demand period as we get into the winter. So I think there's caution around oil, just given that dynamic. And then the other kind of variable is what happens with Russia. There's talk about Russia and potentially reaching a peace agreement. On August 6th, we saw the Trump administration come out with more tariffs on India to essentially punish them for buying Russian energy. So that's another wild card. But to your point, I think with all these dynamics, the stocks are just kind of treading water and oil's kind of meandering. There's not a lot of conviction, I think, in a recovery at the moment.
I definitely want to unpack some of those talking points in a little bit more detail. We can talk more about oil and natural gas prices, but I think, I always like to just take a step back and put myself in the shoes of investors and advisors. And so if we just stay broad here, and Stacey, I know we've talked about this before, but as I was noting at the top, energy currently represents only 3% of the S&P 500. And if we assume most investors and advisors own the S&P 500, or at least some proxy of that, right? Whether actively managed or whatever, in general, I would assume most investors have fairly limited exposure to this sector overall if they are not proactively seeking it out. My question for you is that a reason to seek out energy ETFs to sort of supplement that limited exposure? Or is the S&P 500 trying to tell us something here that maybe investors shouldn't own energy? How do you read that?
Yeah, I think there's kind of two different ways it can go, right? If you can play the space correctly and catch it when it's having those good quarters, like in 1Q of this year, then yeah, an overweight can be a nice way to generate alpha. I think more often what I run into is that people just don't want to own the space altogether. They think that at 3% of the S&P 500, they may as well just ignore it because they don't like the cyclicality or they don't like the volatility or whatever the reason may be. And I think for people in those camp, I would just encourage them to kind of look at their energy exposure and maybe see if they could do something better with it. And what I mean by that is, like, if you look at energy, it has some beneficial qualities, right? It's got the highest dividend yield of any of the sectors in the S&P 500. It's neck and neck for the top free cash flow yield of all the sectors. It's not expensive when a lot of other things feel toppy. So, I would say, rethink the idea of just writing it off altogether because I think there are some attractive qualities here. But I also think you could do more with your energy exposure than just in a broad energy benchmark, right? So I'm going to use MLPs as an example, but MLPs are up about 70% since the end of 2022, and broad energy is up about 5% for that time period. With MLPs, you have a higher free cash flow yield, a higher dividend yield than a broad energy benchmark. And with a 7.5% type yield in the MLP space, that total return over time is really material from just the distribution. So I think for investors, before you write off energy altogether, maybe consider mixing up your energy exposure, whether it's adding MLPs, looking at maybe doing something like Exxon and Chevron in MLPs. I just think there's more ways that you can get benefits and like more out of an energy exposure than just owning a broad energy benchmark. And to your point, like if you were to be overweighting MLPs over the last couple of years, or adding MLPs to your energy exposure and therefore having like 5% or 6%, energy sector exposure, you'd be doing a lot better. MLPs have done very well over the last couple of years. So past performance, no guarantee of future results, obviously, but I think people could get more creative with their energy exposure before they just write off the sector altogether.
Okay, so I am really glad that you broached this topic of looking beyond broad energy. You've mentioned MLPs and you tied performance into this. I'm going to throw a little bit of a wild card at you because I was looking at the performance of a number of energy-related ETFs, and 2 of them again, I noted this at the top, there's been fairly wide dispersion in the performance of energy ETFs this year. So, for example, if I look at the Alerian MLP ETF, ticker AMLP, that is basically matched the S&P 500's return this year, which has been pretty good. But then if you look at something like the VanEck Oil Services ETF, OIH, that's down substantially. It's had a tough year. And so I'd love to have you talk more about that, like what's going on here, because we're talking about a 20% plus return differential just between those two ETFs. And so I'm with you in terms of investors looking beyond the broad energy ETF space, but you have to be careful when you do that, because again, you could have very different performance results.
Yeah, and I think this is why it's important to look at energy much more deeply than just the sector, to your point. Like, you can't paint all of energy with the same brush. So on the MLP side, these companies tend to be more defensive. They're providing services for a fee, so they have some insulation from the oil price volatility. Oil field services does not have that kind of insulation. On the MLP side, there's been a lot of tailwinds from growing distributions or growing dividends. And so when distributions are growing, generally the MLP space does pretty well. And that's something we've been seeing since 2021. And then there's a growth story for them, right? They're set to benefit from growing natural gas demand in the U.S., demand growth for natural gas liquids and some opportunities around that. NGLs or natural gas liquids or things like ethane, propane. So there's a growth opportunity there. On the oil field service side, it's just, there isn't a growth story. The rig counts come down, I think, for 14 weeks straight. Oil and gas producers are talking about how they can do more with less. That's not a great story for oil field services. We had earnings season. I think after earnings, revisions were, there were still negative revisions for revenue and for margin for these companies. And so it's a space where the bleeding is just continuing and you're trying to find that bottom. And unfortunately, the bottom kind of keeps getting pushed out. And so I think, oil field services kind of needs to get to that inflection point of things kind of stabilizing and margins starting to improve. But for now, it just kind of keeps getting worse in terms of kind of the near-term outlook. And so that makes it tough. If oil starts doing a lot better and we see activity pick up, oil field service stands to benefit. But in the meantime, it's kind of a tough environment for those companies.
By the way, not to get off topic here, but when I was looking at these ETFs, I saw with AMLP, that's hitting its 15-year anniversary coming up on August 24th. And of course, that tracks a VettaFi-owned index. So will there be like some sort of office celebration there or something like that? What do you do in the energy department within VettaFi?
Yeah, so we're excited. There'll be a bell ringing later in August that we're excited about. But it's great to see this milestone. We're grateful for getting to celebrate 15 years of AMLP. A lot has changed in 15 years in the MLP space, or even just since the pandemic. Free cash flow generation, buybacks. This is not the same MLP space that existed 15 years ago when AMLP launched. But I think what's important is that the income story around MLPs, the beauty of accessing MLPs in an ETF wrapper where you have exposure to multiple names, and you don't get a Schedule K1, you get a Form 1099. I mean, I think that's still very relevant. But we're excited to be celebrating this milestone with the issuer SS&C Ops Advisors.
Well, congratulations on that. That's the second largest energy ETF out there, right?
That's right. And I think sometimes people don't realize that, second only to XLE in terms of size.
Yeah, it's remarkable. Okay, if we zoom back out from some specific ETFs and we just look at energy more broadly, since you and I last talked, of course, we have the One Big Beautiful Bill Act that was passed. And you and I, we always, try not to wade into politics, and I'm not suggesting that we do that here, but I saw that you wrote a piece where you said that this does tilt positively for oil and gas and midstream. Do you want to explain why that is? And again, we don't need to get into the weeds on the tax code or anything like that, but just what are some of the highlights here?
Yeah, we'll try not to turn this into a tax conversation, but I think high level, it mandates regular oil and gas lease sales, onshore and offshore, so that's beneficial. And then it makes life a little more difficult for solar and wind. payments. So kind of narrowing that window for when you can do a project and get tax credits. The foreign ownership and sourcing rules, I think, are a little cumbersome. And broadly, what's made difficult for solar and wind tends to be positive for natural gas. So high level, it's generally friendly to oil and gas companies. From a corporate perspective, what companies are talking about are the 100% bonus depreciation and a higher interest expense deduction limit. So again, promising not to make this a tax conversation, what we're seeing in the midstream space is companies kind of pushing out that timeline for when they expect to be a material cash taxpayer. So that's been, good to see. And then there's two kind of interesting elements from an MLP perspective. The first is that the bill kind of broadened the list of qualifying activities to be an MLP. So it includes things like activities around hydrogen, geothermal, advanced nuclear, some things with renewable fuels like sustainable aviation fuel. So really kind of broadening what can you qualify essentially as an MLP after the 2025 tax year. So that'll be kind of something interesting to watch and see if we get some new MLP entrants in these different business categories. And the other important thing for MLP direct investors or MLP unit holders or REIT investors is the 20% qualified business income deduction, which is a mouthful and very taxy, but all that to say, it kind of maintains the tax advantage for MLPs relative to C-Corps. It was part of the Tax Cuts and Jobs Act. It was going to sunset this year, and now that's been extended. So that's a benefit for MLP holders, REIT holders. So all that to say, certainly some positives from kind of a broader energy and an MLP midstream perspective.
Yeah, which I would say doesn't really surprise me because we know some of the efforts the Trump administration has made in the traditional energy sector. And so obviously some of these align with that. I guess on that note, is there anything else that you have seen on what I would call the political front as it pertains to the energy sector? Anything else from the administration recently that you think could be beneficial?
Yeah, I think there's some puts and takes here. I think one of the things that maybe isn't widely appreciated is how much positive momentum we see now in U.S. LNG projects. This time last year, there was an LNG export permit pause, but we've been seeing projects move forward with construction. I think 3 projects in the last 12 months have decided to proceed with construction. As of August 7th, Cheniere announced a new contract all the way out to 2050 for purchases from a Japanese company. So there's been a lot of positive momentum in the projects and the sales deals for those projects. So that's a pretty big tangible benefit in terms of long-term natural gas demand in the U.S. Certainly has positive read-through for midstream, but arguably producers as well. So I think that's maybe not been appreciated enough. In terms of other items, there's been headlines about this EU trade deal and $250 billion per year in energy purchases. And I think that's been well covered in terms of that number probably being more aspirational than realistic. And ultimately, we need European companies to actually buy the energy. So that's maybe a less tangible positive. In terms of things that, midstream, for example, would still like to see, permitting reform is probably top of the list. I think that was in the one big beautiful bill out and eventually struck out, but that's something I think that we would still be watching for. And then the potential fly in the ointment here is the steel tariffs. Generally, for what I've seen, I think everybody feels like it's pretty manageable. Companies that are building new pipelines have talked about that being like a 1% to maybe 3% impact on project costs. But those to me are kind of the main puts and takes for a Washington perspective.
Just a few minutes left here. You've touched on several recent drivers, I think, of both oil and natural gas. But again, I always like to sort of boil this down for investors and advisors. And so I thought, I'm just going to give you the floor here because you typically provide us with a nice quick outlook on oil and nat gas prices moving forward. And, those are obviously big drivers for the entire energy complex overall. And so anything in particular that you would note here, just as you look forward?
Yeah, so I think, generally there's some caution around oil. As I mentioned, demand tends to seasonally weaken as we get into the winter, and you've got all this incremental supply from OPEC+. So I think the expectation is that we'll have probably a surplus in the fourth quarter. And the wild card there is, what happens with Russian exports. Does that start to be curbed? Is there a peace deal? I mean, there's so many variables here, but I think generally speaking, there's probably some reason to be cautious. On the natural gas side, we've had a pretty mild summer, and that's kind of weighed on prices there. August 4th, natural gas closed below $3. So as we get kind of into the winter, obviously we'll be looking at, demand related to weather, but also you should have some LNG export facilities kind of ramping up as well and adding to the demand picture. And ultimately, what we're looking to see is whether prices get high enough that producers start to do more from an upstream perspective, bring more rigs on, particularly in regions like the Haynesville or Louisiana, which is very close to kind of the LNG corridor, and that's primarily gas basin. So those are the kind of things that we'll be watching for as the year progresses here.
Well, Stacey, excellent perspective on the entire energy complex. I always say nobody better at this. Actually, sometimes it's a little scary to me because I feel like we're barely scratching the surface on your energy knowledge in these conversations. And so I don't know how much deeper I can actually go, no pun intended, as if we were to drill deeper. But I always appreciate it, and thank you for joining me.
No, thanks for having me, and I always appreciate your energy funds too.
That was Stacey Morris, Head of Energy Research at VettaFi.
Trader designs ETFs for sophisticated investors looking for leverage on the daily, monthly, or quarterly performance on stocks and ETFs. Leveraged ETFs involve significant risks. Consider the investment objectives, risks, and charges and expenses of the ETFs carefully before investing. To obtain a prospectus containing this and other important information which should be read carefully before investing, visit our website at traderetfs.com.
Looking for ETF options from one of the top asset managers in the industry? Visit i.fidelity.com/ETFs to explore Fidelity's lineup and more. Fidelity Distributors Company, LLC, 500 Salem Street, Smithfield, Rhode Island, 02917. Fidelity Investments is an independent company unaffiliated with VettaFi and other third parties on this podcast. There's no form of legal partnership, agency affiliation, or similar relationship between VettaFi, Fidelity Investments, and other third parties on this podcast, nor is such a relationship created or implied by the information herein. Fidelity Investments and/or Fidelity refers collectively to FMR LLC, a U.S. company, and its subsidiaries, including but not limited to Fidelity Management and Research Company LLC, FMR.
I'm now joined by Rob Thummel, Managing Director and Senior Portfolio Manager at Tortoise Capital, who currently offers 5 ETFs, about $1.5 billion in assets. That includes 3 energy-focused ETFs. They have a global water ETF, and then their most recent launch, just last week, is a Tortoise AI Infrastructure ETF, ticker symbol TCAI, which takes a very interesting approach. And Rob is now joining me from the Kansas City area. Rob, we should have done this in person. I'm like right down the street from you.
I know, I'm waving at you through the window here, through my office window, Nate. I think you can see me.
I think I can. So look, Rob, a lot for us to cover. I guess let's start with this newest addition to the Tortoise ETF lineup, the Tortoise AI Infrastructure ETF. Tell us more about this one. It's interesting. Artificial intelligence is clearly a hot theme right now, but I'm not sure the infrastructure story behind this gets quite as much attention as perhaps it should. So tell us more about this ETF.
Yeah, Nate, appreciate that. We're really excited about this infrastructure index, or this infrastructure ETF for a lot of reasons. So obviously we all know about AI, we know about generative AI, and just really the opportunities that generative AI is going to provide. A lot of people are saying that AI will be the new economy. So the approach we've taken at Tortoise is we looked at investors' portfolios and said a lot of people have plenty of exposure to mega cap tech, but where there's a lot of underexposure is infrastructure, because AI doesn't run on code alone, it runs on infrastructure. So we've created this product that we think really captures the heart and the foundational elements of infrastructure. So let me just give you an example of how this works. So for instance, Meta is building this massive data center campus in northern Louisiana. It's going to be spread over 800 acres. That's the size of Central Park. So it's a massive facility. But inside those data centers, that's what we're investing in. The infrastructure inside those data centers that's really foundational for AI to function. So think about, what are we investing in? Well, we're investing in the data storage devices, the millions of data storage devices that companies like Seagate are manufacturing. We're investing in a lot of the cables and fiber optic cable that's being spread across all of these data centers. We're investing in the network switching that moves this data really fast, and companies like Arista perform those capabilities. And then if you think about it, go outside the data center. Well, outside the data center, what do you need? You need a lot of electricity, right? And so in this case, Entergy's the local utility. They're providing a lot of the electricity. They're building new natural gas generation plants that need more natural gas generation. So companies like GE Vernova are building more turbines to generate more electricity. And then you need energy infrastructure really to provide all of that. So when you look at all this, that's just one example. We're building data center campuses all over the U.S. We're building more and more. The U.S. is going to be AI dominant. And so when you think about it, AI infrastructure is really going to be the foundation, and it's going to be the foundation for the future economy. And there is no AI without infrastructure. So we're capturing all of this in one investment product that really invests in the critical enablers of AI going forward.
When you look at those enablers, I'm curious, have you seen the correlations between some of those holdings increase to some of the, what I would call, traditional AI plays? Because, I think of energy and infrastructure is maybe moving a little bit different than your traditional, mega cap growth stocks. So I'm just curious, how do you see those interacting?
No, that's a good observation. So from our perspective, we're not going to invest in the mega cap tech. Yeah, obviously, investors have probably been very successful and already having exposure to those stocks, and that's fantastic. And we view this as our strategy as a complement, and for the reasons that you mentioned. So a lot of mega cap tech is trading at near all-time highs, and being valued off of a PE multiple of 30 to 35 times going forward. A lot of the companies we're investing in are just as important, but aren't trading at near 52-week highs and aren't trading at 30 to 35 times cash flow or earnings. And they're trading at discounts to that, but yet they are growing at similar rates as mega cap tech. And so to answer your question is, the correlation has been much less to mega cap tech than what you would think, because a lot of these companies we still think have been underinvested, and they're underrepresented in investor portfolios, and are just starting to be recognized as opportunities to benefit from this just global and domestic AI build out.
Okay, so that's the AI infrastructure ETF. If we look at some other Tortoise ETFs, I know back in June, you launched the Tortoise Energy Fund, ticker TNGY, which actually, this was a mutual fund to ETF conversion, right? From the Tortoise Energy Infrastructure and Income Mutual Fund. I guess first, talk about the decision around that. Why convert to an ETF?
Well, we were doing what was in the best shareholder interest. Obviously ETFs and active ETFs, we think, are an opportunity to get what we think is a really good energy product out to investors, and we just don't think there's anything out there like it from an energy perspective. So what TNGY does is it provides an income component, like a lot of energy funds do, and it's over a 5% dividend yield. So that's always attractive, but really what TNGY is also doing is looking at where is the puck going in energy, because the energy sector is evolving. And so where is the puck going? And that's really what we're capturing. So when we look at it, we say, okay, the U.S. is the largest energy producer in the world. So we produce the most oil and gas and natural gas liquids in the world. The U.S. has also become the largest energy exporter in the world. That's a huge opportunity, we think. And this is one of the core themes with TNGY. We offer investors access to the largest energy export company. So for instance, a company like Cheniere, it's the largest LNG exporter in the world. We have a significant, that's in our top 10 and will likely be for a long time. Other energy export opportunities are also ways to play this. Now, it's not just about energy exports as well. We see a big opportunity for natural gas. Natural gas, we think, will eventually overtake oil as one of the largest energy supply sources in the world. It'll take a little while, but natural gas has significant opportunity both domestically and globally. So we invest in some of the largest natural gas producers, like an EQT. And then, of course, there's the electricity opportunity as well that is tied to AI. But anyway, we capture all of this in this fund because as we looked at competing products, we really think that a lot of the competing products are more focused on oil. And while oil is relevant, we think the future is going to be electricity, and we think the future is going to be natural gas. And so that's really what we're trying to offer to investors who are looking at the energy sector, probably haven't represented the energy sector in their portfolio in a significant way, but also have an outlook for the energy sector that's a positive one.
Yeah, talk more about that last point, because I think many ETF investors and certainly advisors, they're familiar with products like the Energy Select Sector Spider ETF, XLE, or the Vanguard Energy ETF, ticker VDE. And just so those investors and advisors are clear, can you further compare and contrast those ETFs with the Tortoise Energy Fund? Because again, I think there's some confusion here. You have a growing pool of ETFs in the energy space, and it's always a challenge, I think, for investors and advisors to wade through a growing category like that. So tell us, give us some more detail on that.
Yeah, Nate. So the way I look at it is, these larger ETFs have been out there a while. They're really concentrated in Exxon, Chevron, maybe a Schlumberger, ConocoPhillips, some of the large oil and gas producers, and that's those are fine companies, and will always be important companies. But those companies, I guess, have a lot more commodity price exposure, and so, but basically, in a lot of ways, you're playing, when you invest in those companies, you're investing a little bit more in oil, you're investing more in oil price in the direction of the oil price. And so from our perspective, at least as we sit here today, we think that oil prices are actually going down, not up, in the second half of 2025. And so the better way to play in the energy sector is these emerging trends, and where is the puck going? And so we see energy exports and volumes and owning the infrastructure behind the companies that export all of the energy, and the U.S. being the largest energy exporter in the world, as a better way to play how the energy sector is evolving. We see natural gas, and we see nuclear and other areas of how is the U.S. going to generate all this electricity for AI, and where is that electricity going to come from, and where is it going to be generated? Well, we think natural gas and nuclear and uranium will be the primary fuel sources, and we're going to need a lot more electricity infrastructure as well. And so those type of thematic themes, where the puck is going, those aren't really reflected as well, in our opinion, in other ETFs that are out there. So we are trying to capture the fact that the energy sector is evolving, and where it's going is where we are investing.
One of the interesting things that stood out to me as I was looking at the holdings of this ETF is that it currently holds nearly 20% in fixed income securities. And I should have noted this before. Clearly, this ETF's actively managed. You're the portfolio manager on this. And so you obviously have discretion around those holdings, right? As I understand it, you can go up to 50% in fixed income securities. And so a two-pronged question here. Number one, just where do you see this ETF fitting in a portfolio? And maybe you can first talk about how investors should think about allocating to energy to begin with, like why own a distinct energy ETF at all? And then again, with an ETF like TNGY, I'm assuming this goes on the equity sleeve of a portfolio, but correct me if I'm wrong.
Yeah. So why invest in energy? Well, just think about really nothing works without energy. The economies, the global economy, the domestic economy, nothing really works with energy. Energy is so foundational that we think that every investor should have a portion of their portfolio in the energy sector. I know it's been underrepresented, and the energy sector historically has been thought as a commodity play. But it's way more than that, and that's really what we're trying to express for investors in how we formed our products. Is energy is not just about commodities and not just about the oil price going up and down. Actually, there are a lot of other things going on in the energy sector, and it's really, really important. And so, even though the energy sector has been underrepresented, we think it's been underappreciated, and the sector is frankly undervalued when you look at the energy sector, relative to other sectors that are trading at near all-time highs. The energy sector is not, and so that's the way we look at it. Now, yeah, the fixed income question is a great question. We do have the opportunity to have fixed income in this portfolio. You are exactly right, Nate. This is a equity security focused portfolio. We do though think that one of the attractive aspects of investing in energy is income, and you get equity. You get a lot of income from energy securities, and that are represented in our portfolio. But we use fixed income to potentially enhance that income a little bit for investors at times. We've probably always been around 20%. I know you mentioned we have the ability to go up to 50%. It would be rare that we would go there. We'll probably always be around this 20% plus or minus 5% or so, because what we believe in the long-term growth of the energy sector. And if you think about what's going to drive the stocks in our portfolio, well, it's the global economy. And it's because once again, the economy needs energy to continue to grow. And 40 out of the last 42 years, the global economy energy demand has grown 40 out of the last 42 years because the global economy has expanded effectively most of those years. And so if the global economy expands, if global energy demand expands like it has, then we will just continue to see our companies continue to perform well and continue to grow and then deliver that income and some growth back to investors going forward.
To your earlier comments on why own energy at all, it's interesting because in my previous segment, we were discussing how right now, if you look at the composition of the S&P 500, it's only about 3% allocated to energy. And if we assume that most investors have S&P 500 exposure or some proxy of that, right? Even if you're in active management, whatever, you probably have a very small allocation to the energy space. And so to your point, if energy is involved with every aspect of the economy, and you think about the AI theme and everything else going on, if you believe in that space, you're probably underallocated right now, and you would want to look to a distinct energy ETF to sort of supplement that. Okay, besides TNGY, you offer two other energy-focused ETFs. So the Tortoise Essential Energy Fund, ticker TPZ, and the Tortoise North American Pipeline Fund, ticker TPYP. So TPZ, that launched last December, and as I understand it, this was also a conversion. So Tortoise rolled up 3 closed-end funds, and you converted to an actively managed ETF. What are the primary differences between TPZ and TNGY, which we just discussed?
Yeah, so just a little bit of an angle, a little bit of a plot twist with TPZ. Okay, so I think you've got my excitement about AI, and everybody's excited about AI and the great things that it does. But AI is significant for the energy sector because now the energy sector and the technology sector are intertwined. Both are needed to be successful for AI. AI needs both the energy sector and the technology sector. So from our perspective, electricity is the new oil. Electricity is the new oil because AI is going to need a significant amount of electricity. And if you look and project how much more electricity is the U.S. going to need over the next couple decades, electricity demand is going to grow by 75%. That's significant because over the last 2 decades, electricity demand in the U.S. has grown by almost zero. It's been flat. So this is a huge opportunity, and this is what we capture in TPZ. One of the elements is the electricity demand, and so we invest in several electricity, what I'll call electricity infrastructure names, electricity generation, companies that generate electricity around the U.S. And a lot of it's that increased demand is to meet rising AI applications that'll grow over the next couple decades. Now, the other aspect, the unique aspect of this fund is we say, okay, so electricity demand's going up. What's going to be the fuel supply source? Natural gas and nuclear. That's our answer. Natural gas and nuclear will be the fuel supply sources that are important to generate that electricity. And so that's how what we capture in this fund as well. We capture the increased electricity demand and then the energy supply sources. So companies like Constellation Energy and Vistra, they're the two of the largest nuclear the largest nuclear electricity generation companies in the U.S. So we invest in companies like that. And we invest in a big pipeline network of natural gas pipelines owned by Williams and TC Pipelines and Energy Transfer, because we think that obviously you're going to need that energy infrastructure, that natural gas pipeline infrastructure to generate electricity going forward. And so that's a little bit of the plot twist, I guess, of TPZ relative to TNGY. We concentrated a lot more just in what I'll call the future of energy, the electricity being the new oil, or electrification that's going on in the next couple decades.
Yeah, and I will say your passion around the AI theme and electricity and energy powering that clearly comes across, which I love. With TPZ, just to be clear, there is an income component here as well, right? You have dividend-paying equities. There's some credit and option strategies involved here as well. We don't have to get into the weeds, but there is that income component, correct?
Yeah, we've got some income there. I think it's around a 4% yield right now. So yeah, there's absolutely an income component.
Okay, the other energy-related ETF that Tortoise offers, which is actually currently the largest ETF by assets, is the Tortoise North American Pipeline Fund, again, ticker TPYP. Now, this one is index-based. And so do you want to offer some quick thoughts on that ETF?
Yeah, that's been around the longest. So it focuses on energy infrastructure. It focuses on the pipelines. Why invest in energy infrastructure? We think energy infrastructure is a great asset class. So the U.S. operates the largest energy infrastructure network in the world. So what am I talking about? I'm talking about these pipelines that run across all of the U.S. They supply oil, gas, natural gas liquids. If you've never seen them, you rarely see them, you rarely hear about them. But they're extremely important. So that's what TPYP does. It effectively gives investors access to the U.S. and the U.S. being the largest energy infrastructure network in the world. Virtually all of the most important pipelines are available to be invested through publicly traded securities. That's a rarity in the U.S., or it's a rarity in the U.S. relative to other countries. In other countries, a lot of the best infrastructure on the energy, from an energy perspective, is owned by the government. In the U.S., it's owned by publicly traded companies. So TPYP gives investors the opportunity to do that. And if you just think about what is energy infrastructure, what's its most compelling attribute, other than it generates a lot of income for investors, the economic moat behind these energy infrastructure assets is really important. You just can't replicate this network, this energy infrastructure network that's been built over decades. And so we just think as a pure play way to play, if you're looking just for energy infrastructure, just for pipelines, well, TPYP might be an option for you to take a look at.
Rob, just a few minutes left here. In visiting with you today, clearly your expertise around this entire space comes across. And I was discussing at the top of the show, Tortoise is positioned as an expert around energy and infrastructure. Can you just talk more about the firm's capabilities at a high level? Because, I'm based here in Kansas City. I'm certainly familiar with Tortoise. Clearly have a presence across the country. I think a lot of investors know who you are, but maybe not everybody. And so just talk a little bit more about the investment capabilities and that expertise in the energy arena.
Yeah, absolutely. So Tortoise has been around, was founded here in Kansas City, as you highlighted, in 2002 by several local entrepreneurs in Kansas City. I have been investing in the energy sector myself for over 30 years, 20 years here at Tortoise, and I have 3 fellow portfolio managers who have been my colleagues at Tortoise for almost 20 years as well. And so our focus has been on energy. We love energy for a lot of reasons, but because it is so foundational. And so I would hope to call us the energy experts when anybody across the country has a question about energy. They often think about Tortoise. They often call us and they want our opinion. And we also offer a lot of thought pieces on our website at tortoisecapital.com about everything energy, not just oil, but oil, natural gas, nuclear, electricity. And so we analyze all the energy technologies and have been doing this for decades and really provide portfolios for investors that really capture the best risk-adjusted opportunities, and that's really what we focus on. So that's really what we've been doing at Tortoise for like I said, over 2 decades, and we'll continue to do for the next couple decades, because we all know that energy demand is just going to keep going up, and the U.S. is going to keep generating more energy, and the world is going to demand more U.S. energy. So anyway, that's what we're excited about.
Well, Rob, really enjoyed connecting and enjoy the conversation. I would suggest that next time we have a conversation like this, let's do it over a Boulevard Bear, maybe a Tank 7. We can do it over some Q39 barbecue. But excellent insight this week, and thank you for joining me.
Thanks for having me, Nate.
That was Rob Thummel, Managing Director and Senior Portfolio Manager at Tortoise Capital. That'll do it for this week's ETF Prime. Build your ETF expertise and separate yourself from your peers by registering for the ETF Institute's Certified ETF Advisor program. You can learn more at cetf.org. Next week, I'll be joined by Paul Baiocchi, Chief ETF Strategist at SS&C Alps Advisors, who is simply an excellent all-around ETF resource. So we'll talk about some of the recent industry trends he's seen and touch on a few Alps ETFs as well. Until then, have a great week, everyone.
ETF Prime is hosted by Nate Geraci, president of OTR Media, LLC. Nate is also president of investment advisory firm Nova Diaz Wealth Management. While OTR Media and Nova Diaz are related by common ownership, they are separate and distinct entities, and anything discussed on this program should not be construed as an official statement by Nova Diaz. This program is for informational purposes only and does not constitute investment advice. Investing in ETFs involves risk, including possible loss of principal. Any past performance figures discussed are not necessarily indicative of future results. Some guests appearing on this program may also be financial sponsors of ETF Prime. OTR Media and Nova Diaz are not affiliated with VettaFi or any of its affiliates. VettaFi's participation in this program should not be construed as an endorsement or an indication by VettaFi of the value of any OTR Media or Nova Diaz product or service. Visit etfprime.com for more information.